Well, the tech sector seems to be losing steam this week. It was the worst performer in yesterday's session. It's only Tuesday, but certainly some concern about what is happening in this area that had provided some leadership to the upside. Our next guest has been following the sector very closely for more than a decade. He joins us now, Colin Gillis, senior analyst at BGC Partners. Good morning to you, Colin. I mean, we're looking at the tech sector yesterday, pullback. What's happening here?
Hey, Margaret. So listen, we're telling our investors you want to be very selective in technology names, particularly in a slowing environment. So we split the landscape into two companies that we suggest are still a buy, right? And the first is Apple, because of the fact that not only are we in the educational buying season and the holiday buying season, but Apple still remains the must-have product for digital mobility. Plus, the iPad and the iPhone are going on sale in additional countries. That's a major driver. And then we also suggest Microsoft, right, for those who are looking for some safety and some yield.
Two very different companies there, but let's start off with Apple. I mean, sure. Apple hasn't hit a new high since mid-June. There is some concern that it's really just setting lower highs and now lower lows there. What is behind the pullback? Is that run-up over?
Sure. So, the next major catalyst for Apple, is probably going to be its earnings release that we get in October. There's also potential that we see a new iPod get announced in September. But, the real catalyst for Apple is when the numbers hit the tape and that, we see that the antenna issues have not been a factor, that the consumer is still spending, for these must-have items. Because, investors all across the board are concerned about discretionary spending pull back. But Apple tends to always buck the trend because of consumer loyalty and because of the productivity gains that their devices bring.
With Microsoft, I mean, the trend seems to be that the tech giants are buying growth. They're acquiring sort of these new technology areas in cloud computing, in security. That's what we've seen at least with HP, Dell, and Intel. That's what they're trying to do. Why do you think sort of an old guard tech name like Microsoft has more room to run?
Well, so, there's two real reasons, right? First off, if you look at the tech space in general, it's got some of the best balance sheets overall, right? Big, large piles of cash with no debt. You're talking about Google with $30 billion in cash. That's about $93 a share. Microsoft is $37 billion in cash. It's about $4 a share. And then Apple with the most cash, $46 billion. That works out to be about $49 a share. So, but the thing with Microsoft and the reason we're investing in it, it's a lower beta name that's paying a dividend. So, we're calling it a safety play. It's a 2% yielder right now in line with the S&P 500 yield. And equally importantly, when the board meets in September, we expect that dividend is going to increase by about 15%.
So not a growth story, an income story, it sounds like, for you on that.
That's right.
With Google, you say it's dead money till the fall.
Yeah, absolutely. And that's been correct. I mean, Google's under a fair amount of pressure. More selling today coming in Google. And the problem with Google is that they're in reinvestment mode. And some of these reinvestments may pan off. They're certainly having good success in the mobile arena with their Android platform, but it's not monetizing yet. They still remain very dependent on their search platform. And so, we have to worry about what's the impact of all this current investment for future products going to be on the near-term statement, right? So lots of hiring, lots of acquisitions on Google.